This material is made available to you by or on behalf of the University of Melbourne under Section 113P of the Copyright Act 1968. It may be subject to copyright. For more information, visit the University Copyright website.
All right. Ready? Everyone is here? All right. Welcome to week 7, Property Resources and Management. And today, we'll be discussing a residual method and profit method. What are those? So far, as I told you, there are 5 valuation methods. We did sales and direct comparison method, the basic one, and summation of cost approach. And then we discussed income method, which is income capitalization and DCF. We discussed those in detail. And now, today, we are going to discuss other 2 methods. First one is residual, and then we move to the profit method. Still coming? Right. All right, today we'll be discussing again our residual method and profit method. All right, let's start. What is residual analysis? We call residual analysis. Why do we use residual analysis? It's different from all the other methods. All the other methods, we value the property. Property means land and improvement. But in residual analysis, we only value the land, not the improvement, not the buildings. Right? We use residual analysis to value the land. And we also know this method as hypothetical development method. Because in property development, developers use this method very often to calculate the maximum amount which they could pay for the land. Right. Application of this residual analysis. There are 2 main purposes of this valuation method, this analysis, residual analysis. First one, we use this residual analysis as a valuation method and also an investment tool. This residual method is not very popular or useful in valuation method, but we still do. But it's very useful as an investment tool. We discuss DCF again for those same 2 purposes. As an valuation tool, valuation method plus investment tool. Similarly, the residual method is for the land, calculate the land value. We use this as a valuation method as well as investment tool. I told you that this is not a very common valuation method, but it is used. Recently, last year, there was a good case came out about Melbourne General Post Office. So I'll briefly explain what it was, and they use residual valuation method to calculate the land value. So council value it's a heritage building. Have you seen the photos of General Post Office Melbourne? I'll just try to get it to understand. Well, this is a kind of building. Yeah. This is heritage listed building, and it has been valued for 14.8 million land value for the purpose of land tax. And then owner was against to that. They said this land has no value because the usage is very restricted. They can't sell it. They can't use this for any other purposes. Very much restricted. So land has no value because they can't demolish or build anything or can't do anything. Right. So that was in a VCAT, and it was hearing. And last December, they give the decision. They use two, three valuation methods. Mainly, they use the residual method. And the final decision was the land has no value. Land value is just $1. Because when you use the residual valuation method, replacement, constructed replacement, the different methods you use. So it's costs so much money to reconstruct the similar building. So eventually, land has no value. Right. So what I want to tell you, they use residual analysis to calculate the value. Occasionally, it's very helpful. Right. An investment tool, as an investment tool, it is very helpful. A feasibility analysis which allows the calculate of the maximum amount that should be paid for a site to protect the developer's required profit for the development project. Right. You are a developer. You are very keen to do, for example, a residential apartment. And you are looking for the land. You have a plan, you have experience, you have finance. Right. You are looking for the land. And you know that there's a good demand for the 3-bedroom luxurious plus 2-bedroom luxurious residential apartment in the city. And you have experience and you really want to build residential apartment. So you're looking for the land and you are targeting 20% profit margin. So now we found a really good land, and the problem is how much should you pay for the land? It could be tender or auction. You're not quite sure about the market valuation of that land, and you don't know how much you should pay for the land. Because if you pay too much, what will happen at the end? Total development cost will be higher. And if you keep the 20% profit margin top of that, the sale price will be higher. So if the sales price is above the market level, you won't be able to sell it. Right. So you can't really change the sales price. So what you can do is reduce the cost. With the developed construction cost, you can't really do much. And you need to make sure you do not overpay for the land. So then this is the residual analysis is really helpful to calculate the maximum amount you should pay for the land. It's not the valuation of the land. It's not the value of the land. That's the maximum amount you should pay for the land in order to keep your profit margin. Clear? When you do residual analysis, we'll be using some terms. Development value. This is calculated in one of two ways. So you can calculate a development value from the sales income. So you develop something and you sell. That's the sale price is your value. Or you lease it out. So net operating income divided by cap rate, you get the value. Right. So you get a value from the income, sales price, or the rental income. When you talk about sales revenue, you need to think about sales summary, type of product, number of apartment or units, and sales price, market price, selling expenses, how long it will take to dispose your total development, and everything. When you talk about rental income, rental area summary, again, type and size, rental amount, incentives, very important, 6-month incentive or 1 year, probably too long. capitalization rate, vacancy rate, 4%, 5%, could be 10%, or it's pre-let, rental loss or rental profit, outgoings. What are the outgoings? There are different outgoings. So you have to think about all these things, and other costs, marketing, promotion, and commissions, sale commission. Right. When you talk about yield, there are 3 different yields, depend on your situation. If you are a developer, your development profit divided by development cost. Right. If you are an investor, your net return divided by purchase price. If you are an owner-occupier, your yield will be imputed rent divided by total capital employed, or your equity. Right. We'll do this. Another important thing when you do residual analysis is building costs. This is one of the biggest part of the residual analysis. This consists of forecast construction cost and professional fees associated with the development. Sometimes you wouldn't, the calculation wouldn't say professional fees, but it must be there. Probably 10 to 12%, might be 10%, that's average. Right. Construction costs are usually calculated based on the gross building area. You will get net floor area or net lettable area, then you have to calculate into the gross floor area and a per square meter construction rate. While building area is expressed as a net amount, the gross building area must be calculated, and this is based upon building efficiency. You get 75%, 80% or 85% building efficiency. You'll understand these things when you do a calculation easily. Right. All right. Another important thing when you do residual analysis is finance. Finance means we don't have money, we borrow money. Right. So we borrow money for 2 reasons in development scenarios. First occasion, to buy the land. The second occasion, to do the development, construction. So interest calculation will be slightly different in these 2 methods. When you buy a land, you have to pay the full price to the vendor at the beginning of the transaction. Right? Otherwise, you wouldn't get the land. Right? So say you borrow 100%, and you have to borrow 100% to pay to the vendor. So you are interested, you have to pay interest for that loan amount from the beginning. Right? So you have to pay interest for that land, that loan from the beginning. But when you do the development, construction, how do you get a construction loan? Any idea? Say 20 million is approved as a development loan. How do you get the construction loan? Do you get that 20 million from the beginning? But your loan is approved. This is a 20 million, and you can do the construction. Now, how do you get that money? Gradually, yeah. We go progressive payment. So at the beginning, you get the, say, 25%, 5 million, and then once you completed that stage, probably 1/4 of the construction, then they will check the progress, and then they will release the second stage. And once you get the second stage, you have to do the development from that money, and they will come and check the progress. They're happy, then release the third installment. That's why we call progressive payment. Progress payment. Yeah.
With that, if say you've loaned $10 million, or you've got $10 million from the bank, and you stage it in a way where you don't actually spend the $10 million.
No.
Say you might spend $9 million, and you save yourself $1 million. Do you still have to pay interest on that remaining $1 million because the bank has allocated that?
No. That's what I'm going to tell you now, right? So now halfway, you borrowed only half of money. So you pay interest for the, say, 20 million loan only for 10 million. Right? So construction period is 1 year, and 4 stages of the loan release. First stage you get 25 million, and then after 6 months, second stage released, you get 10 million altogether. Now you have to pay interest only for the 10 million. That's what you have borrowed. And after another 3 months, 4 months, or 3 months, you're progressing well, and bank will release the third installment, another 5 million. Now you have borrowed 15 million. You only pay interest for the 15 million, not for the whole 20 million. And for the last stage, you get the last 5 million. So now your total loan amount is 20 million. Then you have to pay interest for the 20 million. So you pay interest only for the amount you have borrowed. So your interest, so loan borrowing is like this. So your interest payment is also like that. So if you calculate interest for the 20 million from the beginning, you pay interest double. For example, at the beginning you have no borrowings, and at the middle you have half a borrowing of the full loan approved amount, and at the end you have borrowed full amount. So if the construction period is 1 year, how do you calculate the interest? You calculate half, 50%. Because at the beginning no loan amount, at the end we have borrowed the full amount, we get the average half. As a rule of thumb, we calculate 50% of the interest for the construction loan. Clear?
So the period of the payment of the loan is related to the construction phase, earthwork or the structure?
Construction work. Construction work.
It's related to the progress of the
Yeah.
construction.
If you are delayed, you won't get the loan amount at the time. Once you progress, yeah, then you will get the loan amount. Right. So for building finance, 50% rules apply. And interest is paid on 50% of the construction time only, because loan money is drawn down in stages, not all at once. Right. For holding finance, interest paid on the entire building. That's for the land, because all the loan money is drawn down at the time of land transfer. Clear? Yeah.
And when we are selling, are we considering the same rule because we are not selling all the
Exactly. We assume we do the sailings equally. So then, when we repay the loan interest at the beginning, we have the full interest, and we don't have money. But at the end, we have received the full money, and we pay the full loan. Again, we get half. Very good. So in that case, we assume that we have a sales equally throughout the sales period. Clear? Yeah. Practically don't like that, but yes. All right. And then when you do residual analysis, we have to think about the profit margin. How much profit? 15%, 20%, 12%? Or what's the required profit margin? This is a direct reflection of the risk involved, expressed as a percentage of total development cost. You can, normally percentage of the total development cost. Sometimes you can express as a value, percentage of the value. Gross residual land value and net residual land value. These are two important concepts when you do residual analysis. Gross residual land value means cost of the land, all other related fees, conveyancer fees, legal fees, agent fees, plus land holding cost. 3 items mainly. This is land value including land holding, finance and purchase, all the other purchase expenses. Land plus land related expenses plus finance. The net residual land value means just the land value. Just the net land value. That's what we are looking for doing residual analysis. developer's equation. If you are a developer, how do you calculate the value? Very simple. Get the total cost of the land, total building cost, finance cost, profit, and marketing and sales. This is the developer's equation. Very simple. All the cost elements are there. Then how to calculate the profit? Similarly, if you don't know the profit, twist the formula around and you still can find it. Profit equal value and then subtract land value, building value, finance, and marketing. And then if you want to calculate the land value, again, you can calculate the full value and subtract building value, finance, profit, and marketing. Then you get the land value. Normally, we reduce marketing costs from the value or sales price. Then we subtract all the others from the net realization value. We'll do it when you do it. All right. Simple question first. How do you calculate the value of the development? Now, you are a property developer. How do you calculate the value? First, starting point is you are buying a land. Think really, right? You buy a land, the land cost. And then land-related expenses, stamp duty, legal fees, conveyance fees, these things come up. And then land holding cost. Assume you borrow full amount, for instance, so then you have to pay interest. So that's the total we call land plus land value plus residual. Land cost, total land cost. And then you have to calculate the total construction cost, including building cost, construction cost, contingencies, professional fees, and then top of all these, construction finance. Altogether, that's the total construction cost. And then plus, add these together, that's the total development cost. And then at your profit margin, 15%, 20%, whatever you want. And then add them up, you will get the value of the development. Right? This is very simple. Very simple. Everyone can understand. But in residual land value, what are we looking for? We are looking for this one, the very first one. We can calculate all the other numbers, and we have to find out what this is. So in residual value, we start from the bottom. We can calculate the value of the development, sales price, and we subtract one by one. Right? We subtract all these one by one, and we'll come to this way. This is net residual land value in residual analysis. And this figure is gross residual land value. Right? Yeah.
Do you take the market values for the value of the development? Market sales?
It is a market value. It is a sales value. If it is rental income, divided by cap rate, we get the value. Right? Yeah.
If an agent turns around and says in the property report, say it's worth $15.5 million, what guarantee do you have that that value is actually worth $15.5 million? Because if you're using this formula, you're making your assumption of the RLV based on the total value.
Sorry.
I'm just thinking, like, if there's a vacant plot of land and it's say 15 million, and the estate agent turns around and says it's worth 15 to 15.5. Using this formula, you start with the sales price and work it back to get the RLV.
Good question.
But how do you know it's correct?
Good question. And this, as an investment tool, you wouldn't get the market value of the land. It will give you the maximum amount you should pay for the land in order to keep your profit margin. It's not the market value. It is not the market value. This residual analysis is very important as a investment tool. It does not give the market value of the land.
No, I was talking about the value of the development.
Value of the development.
Yeah, so that number there, you work it backwards, but where do you get the value of the development from? Are you basing it on someone's...
Well, if you're a developer, I have an experience. You know what, say, for example, you develop a residential apartment tower. How much is what's the level? Say, luxurious apartment. 3-bedroom luxurious apartment in the city center, how much is the range? Say 850,000? Yeah. Right. So you know what you are producing. If you think about 2-bedroom, probably 650,000. You know what you are producing. Without knowing anything, you can't do a developer. You do market research before you start your development. And you understand what market needs.
So you need a planning approved development because this is for land though. So how
Of
do you know
course.
what you're putting on there?
You have to have a plan.
So you need to have a planning approved so you know what your yield is to work out the value.
Yeah. Before you buy a land, you have to check everything, regulations and everything, right? Overlays and everything. Otherwise, no point of buying it. That's why you think which area is suitable for your development. And then when the land comes up, then you go for it. Right? Good. So you know the development, total value of the development. And for example, you develop a commercial office building, and your plan is to lease it out. You know the price per square meter, and you can calculate the value. Calculate the net operating income divided by cap rate. You can calculate the value. That's the value. And then you can calculate the total construction cost. How do you do it roughly? You can use construction guidebooks. Rawlinson. There are some other construction books. You can calculate the construction cost. And then you subtract that one by one. Then you get the gross residual land value. That's what it is. And then get rid of land holding cost and legal and other related expenses. Then you get the net residual land value. That is the maximum amount you should pay for the land in order to keep this profit margin. This is a very basic format of residual analysis. Because the gross sales or the value, and then subtract sales commission and cost, you get the net residual, net realization, net sales. And then subtract developers' allowance for risk. And then calculate the total development cost. And the gross and subtract it from there, you get the gross residual land value and then net residual land value. All right. Example. Prepare an outline residual analysis to determine the net residual land value for a proposed residential development using the following information. You'll really understand how it is when you do this calculation. Right? 40 units, 1 car space per unit. Average unit size is 8 square meter, net building area. Sales evidence, average unit sales price $2,500 per square meter. Building cost $1,000 per square meter. Car park cost $8,000 per space. And finance interest rate is 11%. Profit risk allowance is 15%. Consultant fees is 10%. Can you calculate the net residual land value? I have given you the format in LMS. residual analysis, for example, template. Right. All right, take a few minutes. And yeah, ask any question. Yeah, sure.
Where it says sales evidence, average unit sales rates 2,500 per square meter, are we talking about MBA?
What?
Net building area? Or are we talking?
No.
I'm assuming we're just. It's the same question.
Average unit size 280 square meter, sales evidence, average unit sales price $2,500 per square meter. Yeah, we only can sell a net lettable area.
Yeah, but say building cost. I'm just going to say.
Building cost,
We're just doing.
then you have to calculate the gross floor area.
Yeah.
What's the efficiency, building efficiency? Is it given? Building efficiency, make it 80%. Yeah, good question, good point. Building efficiency.
You don't have a unit mix, it's just 2 bedrooms. 40 units of 2 bedrooms.
Just unit. Don't worry about 2 bedroom or 3 bedroom. Very simplified. Good point.
Check how much is your sales commission? It's not mentioned.
Yeah, more information here. Say 4%. Sales commission. I will pause this. So land holding period is longer. Yep. The profit margin.
So if it's like the revenue,
That's the profit for the developer.
profit.
Profit. Developer's profit.
But
Why do you do a development?
Uh-huh.
You need profit.
Yes.
That's the profit margin.
So this is the profit, and the risk means that you have a higher profit.
Different wording.
Yeah, you-
Risk. Risk is the developer's risk. He's taking a risk.
Yes.
Return of risk. Profit. Say. Okay.
Just different.
Yeah. All right, let's do it. Right. Number of units, 40. Price per square meter is 2,500. The total price, let's see, 80. 8 million. That's a gross sale. I'll get that done here. And sales commission, 4% of this. $320,000, and net realization 7,680,000. Right. So now, developers' profit or return on their risk. How much is that? 20%. Is it 20%? 15%. Right. How do you calculate the 15% of profit margin? Listen, normally 15% profit is on the cost. Right? 15% profit on the cost. How much is the cost? We don't know. We don't know. See, that's why we are going backwards. 15% profit on the total cost, total development cost, but we don't know the cost. If the say total development cost is 100, right? This profit will be 50. Right? And then what is this? This is will be 115. Is that clear? Total development, for example, total development cost is 100, profit margin is 15, then this will be 115. So net realization will be 115. Yeah.
So your total development cost actually consists of the contingency 10% as well?
Yeah. Everything. Clear? This is 115. Then how do you calculate the profit? If this is 115 divided by 115 multiplied by 15. This is the profit. Clear? Those are the small tricky parts. Those tricky parts will be there everywhere in this residual calculation. Because as I told you, we are going backwards. If we do the value calculation, we calculate the total cost and then count the 15% of total development cost. Easy. But now we don't know the total development cost. Right? So again, total development, 15% of total development cost. So this is total development cost is 100. The profit is 15, and this net realization should be 115. Right? And then, how do you calculate? This is 115, so this divided by 115, and profit is 15% multiplied by 15. Okay? Right. And then you can calculate the total development cost. This is total development cost, 6,678,000. That's why residual analysis, it is really important to understand the tricky part. These things will be there everywhere. Right? Right. Now, calculate the building cost. Net lettable area. How much is the net lettable area?
18
80 multiplied by 40, 3,200. Cost per square meter, 1,000. Efficiency, 80%. Right. So, how much is the, I should put another one here. To understand easily. Gross flow area. How much is the gross flow area then? 3,200, it's 80%, and it's divided by 0.8, 4,000. So total development cost is 4,000 multiplied by 1,000. Because when you build, we had to build for the total area, not just the net flow area. That's clear. We are building, net flow area means that's the amount we can rent or sell. But when you build it, we had to build the circulation area as well, 20%. Right. So total development cost, $1,000 per square meter for the gross flow area. Then how many car spaces? 40. Cost per car space is 8,000, and total cost for the car spaces 320,000. So total development cost is 4,320,000. Now we had to calculate the consultancy fees, 10% of that. And then total development cost, not total development cost, these two comes together as 4,752,000. Right. Is it clear up to that?
You didn't put in the contingency sum, so we don't have to put in or what?
Is there any contingencies here?
You said that there was
Ah,
contingency.
that's fine. Just forget it. If you have 5% contingencies, we can add it. Right? If there's any 5% contingencies, you can add it. 5% of before consultant fees. All right. Now construction finance, again important. Listen. Interest rate is 11%. Construction period is 12 months. How we calculate construction finance? These we assume for this instant we borrow 100%, right? So we borrow 4,752,000. And what's the interest rate? 11% per annum, right? So we don't have any problem because the construction period is all for 1 year. If it is 2 years, we have to multiply by this 2, right? But as a rule of thumb, 50% rule applies for the construction finance. So we can multiply by 0.5 or divided by 2. Either way is fine. Whatever is easy for you. So that's the construction finance. Yes, Dylan? All good? Because construction finance is 50% rule applies. Reason we don't borrow the full loan amount, 4,752,000 at the beginning. We get it stages by stages. For example, this is the this is the dollar amount, say 10 million. This is the time, 3 months, 6 months, 9 months, 12 months. At the beginning, we have no borrowings, and halfway we borrowed half amount, and full time period we have borrowed full amount. So our borrowing is like this, and we only pay the interest the amount we have borrowed. Right? So at the beginning is 0, at the end we have borrowed full amount, get the average. This I call 50%. We calculate interest for the 50%, half interest. Right? Simply. All right, clear? Move to the next one. So total construction cost is $5,113,360. I'll get this one here. Now we have calculated the total development cost, and we just calculated the total construction cost. What's included in total development cost? Total construction cost plus total land cost. Right. Now we have calculated the total construction cost. If we subtract total construction from total development cost, you'll get the total land cost, which we called gross residual land value. Right? It's gross residual land value. Now, what is in this gross residual land value? Land cost and land related expenses, legal fees, stamp duty, all those things, plus interest on borrowing. We call land holding cost. So now we have to get rid of everything one by one. Right? So we normally borrow everything. It means land cost, legal and stamp duty, for example. Right? So first, how much is the land holding cost? 11%. Interest, 11%. Pre-construction period, 6 month, construction period, 12 months. So now you buy the land from the beginning, and we have to pay the interest until we dispose our development. Right? So we have to pay the interest for the pre-construction period and the construction period, and if there's any sales period, throughout the sales period too. Right? So total finance period is 18 months. Right. How can we calculate the total holding cost? We can calculate the interest rate for the period. It's easy. Interest rate for the period. Right. How much is the interest rate? For the 18 months, interest rate is 11% for the is per annum. And divided by 12, what's our interest period? 18. multiplied by 18. This is interest rate. 16.5. That's the interest rate for the total period. So, right. And this gross residual land value is 116.5. And then you have to calculate the 16.5. Clear? This gross residual land value is 1.165, and then we have to calculate the interest. Separate the interest, 0.165. 235,801. That's interest. Remember, we are going backwards. We don't know the land value plus land related expenses. We know the end value.
What was the last one? Yeah, that one?
This one?
No. Yeah, that one.
Land holding cost.
Gross residual land value.
Right.
What
Listen. This is net residual land value, means land value. This is plus land purchase expenses. Right? And when we calculate the interest, 16.5, we normally calculate 16.5 top of this. Right? 16.5. So, and this is 16.5. And then this should be 116.5. So how do you get this one? This divided by 116.5 multiplied by 16.5. Same as what we did in profit calculation. Those are the small tricky parts in residual analysis because we are going backwards. Yep. Interest rate 11% per annum, and our construction total period is land holding period is 18 months. Pre-construction period 6 months, construction period is 12 months, total period is 18 months. The 16.5 is for the whole 18 months period. Confused?
Why we don't use the square construction period?
Because we have some time to get planning approvals and everything before construction starts. We buy the land and it takes few months to get the planning approvals from the city council. That period is 6 months. But still we have to pay the interest for the land, loan. Right? And then when the construction starts, again we have to pay, still we have to pay. Until we sell the development, we have to pay the interest for the land, loan. So total period is 18 months. So we have to calculate the interest for the total 18 months. So this gross residual land value is including interest, which is 16.5%. Yeah.
We doubling up. I don't understand why we're not doubling up on construction finance interest. So where's this?
Construction finance is a separate calculation. We do not get anything from the bottom. The construction cost is, which cost is not related to this part or this part. That's completely isolated, right? When it's related to this part, then we had to do that thing. Right. And again that part. Land, less land purchase expenses. How much the land purchase expenses? Does it say anything? I say land purchase expenses is 6%. Land purchase expenses, sorry. Land purchase expenses is 6%. Now how do you do it?
Net land value multiply 6%.
So this is, this is 1,429,000 includes land cost plus purchase cost, purchase expenses, right? So land cost is 100, land purchase expenses is 6%, and this is 106. Clear? This is 106. So how do you calculate the land purchase expenses? This divided by 106 multiplied by 6. 8,902. And then net residual land value is, I have to delete this, 1,348,207. What is this? What is this? Again, guys, what is this 1,348,000 mean? Yeah, what does that mean?
Your maximum can pay this money for this.
That's the maximum amount you should pay for the land. Is that the valuation of the land?
No.
No. Land value could be 2 million, but you can't pay for 2 million. If you pay 2 million, you won't get a 15% profit margin. But land value could be 1 million. Actual value could be 1 million. Then, great, you get extra profit, 300,000. Right. This is a residual method as an investment tool. It's really helpful. So you are really interested on that land, think this auction, and you love that land and you keep bidding, keep bidding, keep bidding. You don't know you bid for 1.5 million, 1.6 million. What will happen? You will lose 150,000 from your profit if you bid for 1.5 million. If you know that you want to keep 15% profit margin, then you have to stop bidding when it comes to 1,350,000. Clear? If you go over, it means you compromise your profit margin. Clear? I'll put the answers on LMS so you can practice again. Right? All right. There's another calculation, but I don't think we had time to do it. All right. Example 2. Don't worry about that. All right. Any questions on residual analysis? It's very simple. It's not difficult at all. That's why I explained briefly and very clearly difference between a calculation of value of development and then move to the residual analysis. Because this is going from top to bottom and this is from bottom to top. That's why you get all these tricky calculations. Right? Right. Can you move to the next part? Right. So that was the residual analysis. I'll stop it there.
So we do the office by ourselves?
Yeah, because no time. Right. I'll put the answers on and you can double check. If you have any questions, you can ask me from the tutorial class. Right. Now we move to the other valuation method. The last one, profit method, or we call it going concern valuation. Okay. We did income method in detail, including tax and risk and everything, gearing and everything. And then we just finished the residual analysis, and now we move to the last one, profit method or going concern method. What is going concern property? Properties are best summarized as properties that are out of the ordinary ones that have a very thin market. These are also called as specialized properties. There are some specialized properties which we can't use any of these valuation methods to value those properties. Called specialized properties, special nature properties. Not very common. You can't really get market comparables. They are not very common. Right? So those kind of properties, there should be a method to value those ones. We use a profit method or going concern valuation to value those special kind of properties. Where the business is sold in its entirely, what is assessed is often termed the going concern value. Because we believe that business is going on. The reason is we cannot separate that property, land and building, from the business activity. That business activity is designed for that property. We can't use that property for any other business activities. So they are together as one. Right? And transfer of ownership of the real estate and business component as a single entity occurs without interruption to the business. And it's hard to find comparable sales. So we can't use comparable methods. These properties kind of unique and they have monopoly. When you talk about monopoly, there are two types of monopolies. One is legal monopoly, the other one is factual monopoly. What are legal monopolies? If the business has license that need to be run that business, that's a legal monopoly. For example, gas station, casinos or pub, those businesses need license. And factual monopoly, it's often the location is unique. There's no comparable location. For example, ski slope, with resort and island resorts, those are special because of the location. They are unique. Right? Earning capacity of business is linked to this specific location or space. So there's a value for the business because of the location, because of the monopoly. And that's why we call them going concern value of the property. We don't really call it market value or valuation. The term we use is going concern value. Types of specialized properties. We call specialized properties. What are these? These are the examples. Theme park, casino complex, ski slope and resort, service station, cinema, hotel, theater, schools, hospitals, medical centers, stand-alone car wash facilities, car parking stations, funeral parlors, cemeteries. Those are unique. All these, we cannot use all these things for the different purposes. The property building is built for this specific purpose. And the business and the property is unique. We can't separate. So we use profit method or going concern method. Right. So when you use profit method, there are two parties involved. We need to get the information from two parties. One is landlord, which is owner of the property, and he receives the rental income. We need that rental income too. And the tenant is the business operator, and he checked the viability of the business and that he established the business. We need some information from him too to value this property. Right. This is important. How we calculate the value of going concern. That's the value of the property. We need to get main three things. One is value of the building and land, value of the property. The other one is goodwill. The other one is any fixtures, fitting, or chattels.
What is goodwill?
I'll come to that. So, right, building and land. We get the property value, which is the landlord part portion. How do you calculate it? What's the return landlord get? Rental income, right? So net operating income, net rental income divided by cap rate, that's the value of the landlord part, which is value of the building and land. Right? Then goodwill. Goodwill means a business create profit. For who? To the tenants. Right? Tenants earn profit, which is tenants earn profit because of the location, because of this property. These are unique. So that the unique location has a goodwill, or license has a goodwill. They earn profit because of that. How do you calculate? That's a profit of the business. And you can see, yeah, profit and rental, two different things. Right? Rental to value the property, land and building from landlord side, and profit is to value the goodwill from tenant side. And then any extra chattels, fitting, plant and equipment, we add the value of those things, any stocks. Right? Because those properties have any stocks, when the tenant moves, tenant don't take those stuff. New tenants come, he uses the same stuff, because those equipments and assets I only need for that property. It's a unique kind of business. Right. What do we need to calculate those valuations? Going concern value. We need final accounts, financial accounts, trading accounts, profit and loss accounts, and balance sheets. And normally we calculate, we get those reports, financial statement for 3 years, not just for 1 year. Why is that? Why do you get financial statements for 3 years, not just for 1 year?
3 years is a lot more on a stabilized basis compared to 1 year.
To make it more generalized. Right. To make it more generalized. We can get it first just last year, but if there is a variation happened that's last year, it will influence the whole valuation. To make it minimized, to make it generalized, more acceptable, we take last 3 years financial statements. And then interest on trade capital and management salary. This is the tricky part. If I'm a tenant, I can put my money into the business and I can charge interest. Right? So when you calculate the profit amount will be reduced if I charge a higher interest. Clear? I charge higher interest on my capital. So I want to higher interest, I charge higher interest. I pay myself. Right. And then I'm a tenant, I'm working for this, my business, and I say, oh, I'm working very hard, I need $150,000 salary per annum. I pay a higher salary to myself. So what will happen? It reduces the profit. Right? Why is that a case? Because normally in this kind of properties, tenants get a landlord get the rental as a turnover rent. It means percentage of the profit. If tenant reduce the profit and landlord get less rent. Clear? So in that case, tenant is not allowed to reduce his salary from landlord share or interest on his capital when you calculate the profit, to calculate the divisible share. I'll come to that. Yeah.
For that case, you usually would have add back the interest rate that you have calculated and the management salary to derive your balance.
I'll come. I'll explain it later. Right. And then we calculate divisible balance. Right. First we calculate divisible balance. Divisible balance is profit. But that profit, for example, landlord rental is 50% of the profit. Right? If the tenant put all his salary and interest charges on that profit, what will happen? The profit will be reduced. And then landlord will get the reduced profit share. Clear? So when we calculate the divisible balance, tenant is not allowed to put his salary or interest. Right? And actually, when you get the financial statements, tenant has put them in. What we do is we add them back. So profit share will be higher. And then we divided profit, say 50-50. Landlord will get his rent by 50%, and the remaining 50 to the landlord, as a tenant. Landlord's rent is 50% of the profit, for example. Right? Landlord will get the 50% after divisible balance, from divisible balance. Then tenant will get his 50%. When tenant calculates his profit of the business, now he can reduce his salary and interest from his divisible balance. Then remaining part is profit of the business. That is his goodwill. That's the goodwill of the business. And we multiply by 3 times to get the average. Yeah.
So the goodwill is actually the 50% that's attributed.
50% minus other expenses, tenant's expenses. Tenant's salary and interest on capital. Right. We'll do examples, you will get.
Then after that is tenant's net profit.
Yeah, it's reduced than the divisible balance.
Why you multiply 3 times?
I'll come to that. Yeah. So element of profit method calculation. What are the elements? I'll go through quickly. Again, gross income. Total income from all the sources. Right. And then purchase. This is like a business profit and loss account. If you have done basic financial accounting, you know what's bank statement. Profit and loss account. We need profit and loss account basically, and balance sheet to calculate this. Right? And all the purchases. Goods purchased to operate the business. Example, food and other stuff for the hotel business if it's a hotel. And then we calculate the gross profit. Gross income minus purchases, gross profit. And then we had to calculate net profit. How can we calculate net profit? Gross profit, subtract working expenses, and then you will get net profit. So what are the working expenses? Operating expenses, including wages, hire of equipment, other expenses, electricity and everything. Rental is not included as working expenses in this case because rent is half of the profit. Could be 50%, 60% or 40%. For example, things it's 50%. Right? So we do not reduce rent because there is no rent. Rent is profit share. Clear? Because in all these kind of businesses, landlord do not get permanent fixed rent. His income is varied. And he wants tenant to run the business. If tenant get the profit, he will get the profit. He will get the rent. For some occasion, landlord will get a small base rent. And after that, 40% or 30% of the profit. There are different scenarios. For instance, 50% of the total profit. Yeah.
Profit, you mean gross profit? Or the
Net profit.
No, the landlord's share.
Net profit.
Landlord,
Net profit of the business before tenant's salary and interest.
including the purchase and the
Everything.
before tenant's salary and
Interest.
interest. Only those two.
Only those two. That's a key thing. Right. Net profit includes profit, these things. Right. I'll go through quickly. Tenants capital, yeah. It will be confusing, yeah. I'll do everything in detail when you do the calculation, right? Tenants capital, I'm trying to go to the calculation quickly, so it will be helpful. Tenants capital, fixed asset. Tenant puts some capital, fixtures, fitting, including equipment, machinery, and furniture. So those are fixed assets. And stocks, unused raw material. So if it's a restaurant, foods, and everything. Part, finished product, work in progress, if it's production. Finished product, ready for sales, all those are stocks. And cash in hand and at the bank for running business. Adjusted net profit equal net profit minus interest on tenants' capital. Right. A divisible balance. Adjusted net profit is divisible balance, and it includes tenant's share and the amount the tenant will require out of business to include her to take the tenancy. The dividing rules as a proportion of the divisible balance, for example, 50%, as a proportion of gross earning or the amount related to the gross earning and visible balance plus a separate interest percentage return on the tenant's capital. You can read through. Right. What is turnover rent? Turnover rent is turnover rent and business performance, not by comparison, because landlord share directly linked to the business performance. Because if there's, for example, island resort or ski park, theme park, if there's no tenants or people do not come, tenant can't get any businesses. And it's not fair, landlord asks fixed rent. What will happen? Then tenant will leave. If the tenant leaves, it's not that easy to get another tenant. Right. So he will lose whole income. So landlord needs tenant to run the business and while getting his rent. Run the business, you earn profit and give some to me. That's the concept. Right. Contract rate and enforce certainty, and it's the incentive to separate business performance and property value. So that's our purpose, right? Annual rent, part of the part of the adjusted net profit, dividing rule percentage, example 50% dividing balance to landlord. All right. Value of goodwill. Difficult to be quantified as marketable asset. That we talk about goodwill in general. Goodwill comes from the person, and adherent goodwill from business, and inherent goodwill comes from the site. What is the personal goodwill means? If you have a business and the business run by a very reputed person, for example, there is a tennis school going to be started at tennis center in Melbourne City. What's that tennis court? Road. I forgot the name. Right. And who's going to start it? Say Serena Williams. That's a good deal, huh? Great good deal, Serena Williams. So it's that person has a good deal. People will be coming, oh, Serena Williams. Oh, that will be good. So if that person has a good deal in the championship. So that's personal goodwill. Adherent goodwill, business advantage. For example, when you talk about casino, we can say Crown. It's a goodwill. They have a reputation. Right. Inherent goodwill, site, the location. When you talk about one location, people know, all right, that's it is. It has a goodwill, right? Annual business profit earning before interest, tax, depreciation, and amortization. We calculate the business profit before that, before division, right? Value of business goodwill, tenant share, value of business, goodwill, tenant share, or annual business profit multiplied by selected year's purchase. And since we get 1 year, so we need to get 3 years, so that's why we multiply by 3 to make it more generalized. All right, let's do it. Let's see. This is the simple model. Calculate the total income. Calculate the total income. Could be different income sources. 1, 2, 3, another income. And that's gross income, gross turnover. I'm trying to go through fast to finish the calculation, right? Less total purchase, and you calculate the gross profit. And subtract total operating cost, staff salary, and other operating expenses. And you do not subtract tenant's salary as a manager in there, only the other staffs. Right? So you calculate the net profit. So net profit, you get the 50% balance to the business. 50% profit go to the landlord as a rent, and the rest 50 come to the business. That's divisible balance, right? So now from here onward, you can calculate the business profit. Right? Now you can calculate that your salary, because that's your profit. Tenants subtract his salary, then annual business profit after all his deductions. And then this is annual business profit. So when you calculate the value, going concern value, this is the going concern value part. Capital value of business, goodwill, 3 times, goes for 3 years. And 50% of divisible balance to the landlord as annual rent. That's this divisible balance. Right? And capitalize at market deal, because that's the value of the property, rental income divided by cap rate. Yeah.
Assuming this is a special asset class, how do we know the cap rate?
Good question. That's a really good question. Expert valuers, there are different valuers for specialized properties. They have that valuation, cap rate. Very good question. It's not widely available. The valuers are specialized for specialized properties. There are some valuers. They only do specialized properties.
I can find the cap rate, meaning I can use the income capitalization to...
Yeah, you use income capitalization in here too. Plus goodwill. Because the land is connected to the business. Right. They are together. We use income capitalization method, same as the other method when we do before, plus goodwill.
I know in aged care and retirement villages, you don't take into account the operator's net income, you only take into account the market, assuming the tenant can go and a better manager would come, so
yeah.
the market income would be the taken one. In this case, we focus on that particular operator.
Yeah. Yeah. Right. So this is the part of the going concern value. Capital value of the business, we calculate goodwill 3 times. That's normally 3 times. Right. And 50% of divisible balance to the landlord as annual rent. And we get divided by cap rate, that's the property value. And these two together. Capital value of the enterprises as a going concern value, value of the land and building, this green part, and goodwill, that part, and any chattels, fixtures, fittings, cash in hand, or anything. And that's a going concern value. CLMS, for example. Just go through quickly. Profit method. Profit method example. Hope you can finish it in 10 minutes.
What is the data?
It's in a Word document in the LMS.
Profit method.
Yeah. So then you will sort out all your problems. It's theory, I'm telling you wouldn't get it. You actually get when you do the calculation. Right? Right. Valuation of a small accommodation establishment. A local hotel has 50 rooms. 75% are single rooms. Standard rates of single room is $80 per night. The remaining rooms are double rooms and the standard room rate is $120 per night. The hotel has an estimate average overall occupancy rate of 65% per year. That's the main income source. And the other source of income from the hotel's business operation includes food and beverage income, 20% of the total income, and the other income, which is approximately 5% of the total income. These are just tricky part to calculate the income, but basic thing is calculate the income, right? Simply. Just make it a little bit complicated for nothing, right? You have analyzed the operation of the business and have decided that the cost of operating the business includes the purchase of necessities, which is estimated to be $300,000 per year, and total operating cost, which includes manager's salary $100,000 plus staff salary of about $300,000, not including, plus $300,000, and altogether is $400,000. And other operating expenses about $100,000 per year. In addition, the estimate of owner's investment include furniture and fittings of $20,000 and stock and cash in hand is $10,000. Current interest rate is 4%, assuming 50% divided balance of net profit. A capitalization rate of 8% is derived from market evidence. Based on the above scenario, please complete the income schedule below to identify the total revenue and room yield. Then conduct a valuation of the going concern using the profit method. All right. Just do it together. Everything is done for you, the format. Just do the numbers. Just calculate the numbers. Number of rooms available per year. How many rooms available per year? Yeah. Right, yeah. 50 rooms multiplied by 365, yeah, 18,250 rooms available per night. Average overall occupancy rate per room, not the percentage, 65% of this, 11,863. This is occupancy per annum. Right? Single occupancy rate, 75% of this. Average single rent net room rate per night. This is multiplied by 80. That's income from single room. Then double room occupancy rate, 25% of this, and total income from that is multiplied by 120. The total room income, this plus this, and then room yield. This divided by total number of rooms. $59 per day. Right. This is just a simple calculation. This is not a profit method, right? You'll get the all sort of things when you get a calculation. But come to the real calculation. Profit method calculation. Right. Gross income, turnover. Room income, how much is that? 1,067,625. We have already calculated. Right. Food and beverages income, again, what does it say? Food and beverage income, 20% of the total income. Right. And other income, which is approximately 5% of the total income. So this is 20%, this is 5%, and the room income is then what is the 75% of total income. Clear? All right. So 75% is 1,067,000, and what's the 20%? Divided by 75, multiplied by 20. 284,661. Other income is this is 20%. How much is the 5%? 71,175. Clear? So it says other sources of income from hotels business operating includes food and beverage income is 20% of the total income, and the other income, which is approximately 5% of the total income. Right? So this other income is 25%, and then room income is 75% of the total income. Clear? Again, this is a calculation. This is not the profit calculation, profit method calculation, right? Right. Total income. That's the figure we wanted. 1,423,000. So let's purchase cost. How much the cost? Estimated $300,000 per year. $300,000. So gross profit is 1,723,500. That's gross profit. Right. And deduct total operating cost. Staff salary, how much that? 300,000. Other operating expenses, 100,000.
So it's 1.1 million because it's minus 300,000. The gross profit is.
Sorry. Very good. Oopsie. I should add. Very good. Right. Thank you. Right. Net profit. I add this. Add all together. So this is the net profit. Before manager's salary, it means tenant. Tenant work as a manager and get $100,000. So landlord will say, no. That's you. You can say 200, 300,000 for your salary. It's just not right. Right? You need to add that back. If you subtract that 100,000, your net profit will be 623,000. Then half of this, 50%, is 300,000. So landlord will get less rental income. So it is tenant's salary as a manager is not allowed to subtract, deduct from here. So now 50% divisible balance to the business. It means this 50% goes to the landlord, 50% remain in the business, right? To the tenant. 50%. Or multiplied by 2. This is 361,750. This is 150% goes to the landlord's rental income. Other 50% remaining in the business to calculate the net profit. Now, this 50%, we assume this is the business profit. Now, tenant can subtract his salary, 100,000, and that annual business profit is 261,750. Plus, I saw something here, interest. In addition, the estimate of owner's investment includes furniture and fitting 20,000 and stock and cash in hand 10,000. So if tenant put this capital and money into the business, he is allowed to charge interest. So interest rate is 4%. So what's the total amount? 30,000. Just put it here. Into 4%. How much is that? 1,200. Right? Yep. So annual business profit, tenant's business profit is 260,550. Now, this is the valuation part. Important facts for the valuation. Capital value of the business. This is profit, and we capitalize it by 3. Normally we calculate by 3. That's the standard. 781,350. Yeah. And then 50% divisible balance to the landlord, which is this 723,500, and cap rate is 8%. This divided by cap rate. Is it right? Oh, sorry. This is wrong one. 300. 3 divisible balance is 300. Yeah. 4 million, 4.5 million. So now we have all the information to calculate the going concern value. Value of the land and the building. This is goodwill. This is the goodwill. And value of fixture, furniture and cash in hand, 30,000. Total value of the building. Value of the business as a unit, because property and business as a unit is 5,333,500. We call going concern value of the specialized property. I wish I had more time. Yep, you can ask any question.
Yes. Is there any rationale behind why you claw back interest on tenants' capital, but you don't claw back the capital as well? So what I'm talking is that on that part where you less the manager's salary and interest on tenants' capital, why do you not less the capital as well?
Capital is...
Because it's what that belongs to the manager anyway.
Yeah, but it's not part of the profit. It's in the balance sheet. It's not the operating expenditure or income. That should be sitting in the balance sheet, not in the profit and loss account.
Yep.
It's not expenditure.
Yep.
It is sitting there, but the interest you pay on that capital is the expenditure.
Yes.
That's why he is not allowed to subtract that interest, because it reduces the net operating net profit.
Okay.
But that 30,000 is it is sitting in the balance sheet.
Yep, as a cash.
Asset, right?
Yep.
So it's an asset. As a liability for the business, asset of the tenant. Right? So it should be added to the business when we value the business. Yeah. Clear, basically, what you need to understand, you need to calculate these three. Again, summary, brief summary. To value the going concern property, you need to calculate three things. One is value of the land and the building. How do you do that? Get the divisible profit and divide it by cap rate. And then calculate the goodwill. Get the divisible profit and subtract any tenant's salary or interest, and then get the net profit and multiply by 3 times. And then any chatters, additional value, stocks and everything. That's a value. It's not that complicated, right? I wish I had time to do another calculation, but you do it. I'll put the answers on. You have the answers on, and do it again. If you have any question, you can ask me in the tutorial class. All right. Here, this course consists 2 parts: property resources and management. So I do property resources part, and Elaine and some guest lecturers will do property management part. So I finished my part today. The property resources part is done. So I'm not coming to do lectures from next week onward, right? Now next week Elaine will come, and a couple of lectures, and then some guest lecturers will come for the few lectures. So please come to those lectures and get the maximum of guest lecturers especially, right? They are industry experts, so get the maximum out of them. And yeah, but I'll be doing all your tutorials from next week onward too. Any question? All right, thank you so much for your support, and see you in the tutorial class. Just in time. Now, we'll do later. Today still we do, I think, what's in there?
Recapping on LMS. Is that what we'll be doing in the tutorial?
I don't remember. I have to go and check. Whatever it is in there, we'll be doing. All right.